Welcome to the Deep Dive. Today we're taking a close look at the world of cryptocurrencies, specifically Bitcoin.
Yeah, it's such a dynamic space. And, the daily life of someone investing in it can look incredibly different depending on how they approach it.
Exactly. So the big question we're tackling is, how do these different Bitcoin investment strategies actually shape someone's day-to-day?
We're going to sort of contrast two main types, right? There's the long-term hodler
Right, the patient ones.
and then the much more active trader. Two very different mindsets.
And our mission here is really to show you what it feels like to be in each camp. We'll get into their routines, the tools they use.
The platforms, yeah, and just the whole mentality behind each approach.
It's based on a really interesting analysis. Un día en la vida de un inversionista de Bitcoin.
Which, yeah, translates to a day in the life of a Bitcoin investor. Gives a great snapshot.
So what can you expect? Well, you'll get a feel for the hodler's methodical calm versus the trader's pretty intense analytical day.
And we'll also touch on the challenges, the psychological hurdles they both face, because it's definitely not easy either way.
Okay, let's dive in. First up, the hodler.
The long-term investor.
Their whole philosophy seems to be like this is a marathon, right? Not a sprint.
Absolutely. Deep conviction in Bitcoin's future potential. And that seems to lead to a, surprisingly calm daily routine compared to what you might expect.
How does that work in the morning? I mean, the market's always moving. Do they just ignore it? Or is it something else?
It's more like they don't have that compulsive need to check the price first thing. Their morning might be about, well-being, exercise, maybe some quiet time.
Okay.
Their focus when they do check in is broader. Big news, regulatory stuff, adoption trends, tech developments.
So information gathering, not trade signals.
Exactly. It's about reinforcing their long-term belief, not making a quick move.
That makes sense. So if they're not glued to price charts, what are they spending their time on? What's the research look like?
It's all about the fundamentals. They're digging into things like the halving, the scheduled reduction in new Bitcoin supply.
All right, a core protocol thing.
Or the Lightning Network development, which is about making transactions faster and cheaper. They might also look at Bitcoin's role geopolitically or as an inflation hedge.
So it's deep work.
Yeah.
Understanding the tech, the economics.
Definitely. It's an intellectual investment, really. They're trying to understand the core value proposition.
It seems like their main tool isn't a trading app then, it's continuous learning. Why is that so critical for them?
Well, yeah, because that deep understanding, that conviction, that's what gets them through the massive price swings.
Okay.
They might follow thinkers like Michael Saylor or Jack Dorsey, not for trading tips, but to grasp the bigger picture, the macro trends, the tech philosophy.
Right.
This knowledge base is their shield against, panic selling when things get volatile. It lets them stick to the plan.
And that plan often involves dollar cost averaging, DCA. Can you unpack that a bit?
Sure. DCA is basically investing a fixed amount of money, could be $50, could be $200, whatever, on a regular schedule, maybe weekly, maybe biweekly.
And the key is you do it regardless of the price.
Exactly. Whether the price is high or low, you buy that same dollar amount. It averages out your purchase price over time.
Sounds like a great way to manage emotions. Are there downsides, like situations where maybe it isn't the best move?
Well, some argue if you're sure it's the bottom of a bear market or in a massive bull run, maybe putting more in at once is better. But DCA's power is removing the guesswork and emotion.
Right.
It turns volatility into an automated buying opportunity, which is psychologically pretty powerful. And yeah, platforms like Kraken or Coinbase make it easy to automate. Set it and forget it.
Speaking of set it and forget it, security must be huge for them if they're holding for years.
Oh, absolutely paramount. It's the bedrock, like you said. They understand that leaving large amounts of Bitcoin on an exchange is risky.
Vulnerable to hacks and stuff.
Precisely. So they almost always move their holdings to hardware wallets, Ledger, Trezor, those kinds of things.
Cold storage. Offline.
Exactly. The private keys are kept offline, away from online threats, and they're meticulous about their recovery phrase, that backup sequence.
You check it periodically.
Good practice, yeah. Because if you lose that, you lose everything. That security gives them the peace of mind to actually hold long-term without constant worry.
Okay, so that's the hodler. Calm, patient, focused on fundamentals and security. Now let's flip a coin entirely. The active trader.
Yeah, a completely different reality. It's intense, constant analysis, risk management. It's a battle against the market day in, day out.
Sounds exhausting. How does their day even begin? It must be early.
Super early, often before the main markets are even properly awake. First thing is diving into price charts. TradingView is a popular platform for this.
And they're looking for it.
Specific technical patterns, candlestick formations, support and resistance levels, trying to read the market's immediate intentions.
So pure chart reading. Or are there specific indicators they lean on?
They use a whole toolkit of indicators, things like the RSI, the Relative Strength Index, to check momentum.
Overbought, oversold kind of signals.
Exactly. Or Bollinger Bands to gauge volatility and potential reversal points. But they rarely rely on just one. They look for confirmation, multiple signals pointing the same way.
It's like detective work on the charts.
Kind of, yeah. Trying to piece together clues for the next likely move.
And what about outside news? Like a big economic report comes out. How does that factor in?
Hugely important. They are hyper aware of macroeconomic news,
Well,
U.S. inflation data, Federal Reserve interest rate decisions, jobs reports.
things that move markets quickly.
Instantly. Unexpected news can completely derail a technical setup in seconds, so they have to be constantly vigilant. A surprise announcement can trigger massive volatility.
Okay, so they've done the analysis, they're watching the news. Then comes execution, put on a trade. The source called their screen a command center. What does that actually look like?
Well, based on their analysis, they'll enter or exit positions. They often use limit orders, which let them specify the exact price they want to buy or sell at.
Avoids getting a bad price in a fast market, right?
Exactly. And absolutely crucial is using stop-loss orders.
To limit the damage if a trade goes wrong.
Non-negotiable. It automatically sells their position if the price drops to a certain level, capping their potential losses. It's all about managing risk. And yeah, the pressure is immense. Every click matters.
That intensity, day after day. How do they avoid burnout? Does the source mention anything about that?
Well, the afternoon often involves monitoring those open trades, maybe adjusting stops, tweaking the strategy if market conditions change. Risk management is just as vital as finding good entries.
Always questioning the trade.
Constantly. Is my initial reason for this trade still valid? Has the market shown me I'm wrong?
As for burnout, yeah, the analysis hinted at long hours, 10, 12 hours sometimes glued to the screen. It takes serious mental stamina.
Wow. And then after that intense day, there's a post-market routine, reviewing trades. Yes, a crucial step. They meticulously log their trades, profits, losses, why they entered, why they exited.
Is that just for record keeping? Or something deeper?
Much deeper. It's how they learn. Analyzing mistakes, identifying what worked, refining their edge for the next day. It's about continuous improvement.
Makes sense.
And importantly, they often make a conscious effort to disconnect afterwards. Step away from the screens. Avoid over-trading when they're tired and ensure they're mentally fresh for the next session.
So very different styles, hodler versus trader.
Right.
But they're both playing in the same, often crazy Bitcoin market.
Yeah.
They must face some common challenges, right?
Yeah, definitely. The biggest one is just the sheer volatility.
Right.
For the trader, it's the sudden, sharp moves that can wipe out a position or lead to liquidation if they're using leverage. Very stressful, immediate risk.
And for the hodler?
It's more psychological endurance. Seeing your investment drop 50%, 70%, even 80% during a bear market, and having the conviction not to panic sell, that's a different kind of gut-wrenching challenge.
Both require nerves of steel, just in different ways. What about security?
Still a major concern for both, but slightly different focus. The hodler is obsessed with protecting their private keys, often held offline. Lose the keys, lose the Bitcoin.
Right.
The trader, who often keeps funds on an exchange for quick access, is more concerned about the exchange itself getting hacked. It's a different vector of risk.
Okay, so technical risks, market risks.
Yeah.
What about the mental game? The psychology?
That's huge for both. The source mentions classic investor pitfalls, FOMO, the fear of missing out when prices are rocketing.
You feel like you have to jump in.
Exactly. And FUD, fear, uncertainty, and doubt, which spreads like wildfire during downturns, making people question everything.
So controlling those emotions is key, regardless of strategy.
Absolutely critical. The analysis really stressed that successful investors, whether hodler or trader, master their emotions and stick rigorously to their plan. Discipline is everything. It really is a mental game as much as anything else.
So wrapping this up, it seems clear that a Bitcoin investor's day, their whole experience, is really dictated by their chosen strategy and, maybe more importantly, their mindset.
Yeah, the hodler relies on patience, deep conviction, riding out the storms for the long term.
While the trader needs discipline, sharp analytical skills, and really tight risk management to navigate the daily, sometimes hourly, swings.
And, it's not like one way is definitively right or wrong. They're just different approaches.
True, but both clearly demand a serious understanding of what you're doing and why. You can't just stumble into either successfully.
Definitely not. Commitment and knowledge are essential for both paths.
So maybe the question for you, the listener, is, hearing about these two very distinct approaches, the patient hodler, the intense trader, which one resonates more with you? Which strategy do you think might align better with your own personality and how you think about risk? Something to think about.